everyone, and thank you for joining us today. My name is Kelsey Lefebvre. Before we get started, I'd like to offer a few technology tips to keep in mind while you're reviewing today's webinar. First, all attendees are muted throughout the presentation. Once in a while, it's a good idea to tap your mouse so that your screen does not go to sleep during the presentation. There will be a time for questions and answers at the end of the presentation. Questions can be entered in the chat box at any moment during the presentation. To send your question, click on the question mark button in the top right side of your screen to expand a question box where you can then type in your question. And then lastly, a recording of today's webinar and the presentation materials will be available at farmcrediteast.com as well as on our YouTube channel. And before I hand it over, just a quick disclaimer. This information is presented in good faith and is not intended for investment, tax, or legal advice. And then a quick introduction. Today we have two lead economists from CoBank. We have Tanner Ehmke, who is the lead economist for grains and oilseeds. And then we have Jacqui Fatka, who is the lead economist for farm supply and biofuels. So now I'm going to hand it over to Tanner to get us started.
Okay, we're just going to wait for a technology thing here to hold on one second, folks. I need to share my screen. And Kelsey, have you enabled share screen?
Yes, I have. Is it working for you?
Here we go. Now we've got it. Okay. Bear with us, folks. We're going to be with you here in a second. Okay, Kelsey, can you see my screen?
Yep, looks good.
Wonderful. Okay, well, everyone, thanks for joining us this morning. I'm Tanner Ehmke, lead economist for grains and oilseeds at CoBank in Denver, Colorado. We're going to provide our outlook for the year ahead for grains and oilseeds. And with me is Jacqui Fatka, our lead economist for biofuels and farm supply. She's going to provide her outlook with regard especially to biofuels, because that is a huge impact on what happens to the grain and oilseed balance sheet. So I'm only going to touch on those fundamentals momentarily and then hand it over to Jacqui for her expertise on those sectors. So first of all, quick review of where we're at, on prices. With the prices you see on the screen right now are for corn, soybeans, and soft red winter wheat over the past year. And as you can clearly see, and as you all have experienced, it's been a down year for commodities. For a whole host of reasons. Now, each commodity has its own set of fundamentals that are going to be driving prices. And so, first of all, let's talk about the elephant in the room, and that is soybeans. You can clearly see here the soybean prices, or the line, the yellow line there. Soybeans fell about a little over 20% over the past year. For a whole host of factors we're going to touch on, but we're going to summarize that here. We've got ample supply. We have the second biggest soybean crop on record, on top of ample carryover stocks from last year. We have the expectation for a record South American soybean crop. And on top of that, we have a collapse in the Brazilian real. Brazil's currency is the lowest on record versus the US dollar, and that has made their soybean exports much more competitive versus the United States. We turn our attention now to soft red winter wheat. That's the blue line. Soft red winter wheat is down about 10% over the past year. Not as bad as soybeans, but we've got, again, expanded supply in the United States. We had bigger crops across the board for all the different classes of wheat. The soft red winter wheat is the third biggest class. We have our hard red winter wheat and spring wheat. The hard wheats both had bigger crops, and so that's really pulled down prices here in the United States. Plus, we have a strong dollar, which has inhibited our ability to export versus all of our competitors overseas, especially Russia. And then we've got an improved moisture situation in the central and southern plains, and that is weighing on wheat prices. And then we talk about corn. Corn's had a down year, but as you can see, it's not nearly as bad of a situation as we've seen in soybeans and wheat. So corn prices last year were down almost 1%. We were down a lot more than that earlier in the year, but as you can see in this green line, we've recovered off of the August lows. And what is going on there? We had the second biggest corn crop on record, on top of ample carryover from last year's record corn harvest here in the United States. So combined, we had record corn supplies. And that would dictate, based on supply and demand fundamentals, that we're going to have low prices. Okay, that's just how the fundamentals work. However, if you look at what we've seen in price action over the last several months, that's not been the case. Corn has actually recovered. And that has been the success story here. Although prices are down year over year, prices have recovered because of the resilient demand story, which we're going to talk about here in a moment. So I would say of the three major crops here of corn, soybeans, and wheat, corn has been the surprising success story, given the fact that we've got some strong bearish fundamentals we've had to contend with. And we're going to go over those fundamentals. So the chart you see on the screen here is of crop production from last year. As you can see, we've had bigger crops almost across the board. Corn was the second biggest crop on record. It was down just a touch from last year's record crop. Big increase in soybean production, 4.46 billion bushels. That's up from last year's crop of 4.16. That was mostly driven by expanded acreage. And the story there on soybeans is renewable diesel. I'm going to leave that for Jacqui Fatka to address in her section. But we've had a big expansion in crush capacity here in the United States to fill the rising demand for renewable diesel. And so soybeans really took the reins last year in the expansion of acreage. Most of that was at the expense of corn. And then at the same time, we had an expansion of wheat acreage. You can see there the U.S. wheat crop of all wheat classes combined was almost 2 billion bushels. That was the biggest wheat crop we've had in this country in 9 years almost. And so combined, this supply scenario is going to dictate a low price environment. Low prices are going to have the dual purpose of stimulating demand while at the same time discouraging production. Bear with me one second here. We're having some tech issues. The other issue that we're dealing with is a strong dollar. Why does the strong dollar matter? Well, as you can see here on this chart, the green line is the U.S. dollar index as measured against a basket of other world commodities like the euro, the yen, other important currencies around the world. And then the blue line is the U.S. Ag Commodity Export Price Index. That's a consortium of commodities. Corn, wheat, and soybeans are among them, but it also includes other exports like beef, pork, chicken, tree nuts, you name it. A lot of other commodities are included in that index. And as you can see, as the dollar strengthens, U.S. Ag Export Commodity Index or prices weaken. And what is the relationship there all about? Well, this is about U.S. exports becoming less competitive because buyers overseas have to buy U.S. dollars before they can buy our products. And so as the dollar appreciates in value, they can't buy as much from the United States because our exports become more expensive. And so the alternatives alternative exporters like Brazil, for instance, become more competitive. And so as the dollar goes up, that depresses commodity prices here in the United States. So we've got some fundamentals we have to address here. As the dollar goes up, that makes our exports less competitive, but this is a bit of a head scratcher. One thing that we analyze for price forecasting is the stocks to use ratio. We take all of the stocks of corn, wheat, and soybeans around the world and divide it by use, and that comes up with, and we come up with a ratio for general price direction. Okay, that's going to be a measure of how many bushels we have at the end of the year versus what is used. And the market is going to ration supply if we're tight. And as you can see here on the lines for wheat and corn, the stocks to use ratios are trending lower, whereas soybeans are trending higher. Not a big surprise on soybeans. Soybeans really have the bearish story here, given the record crop that we had this year, or near record crop that we have this year, plus the record South American crop that we're anticipating coming to market in March. Obviously, that's going to be bearish on prices. Big supply means lower prices, and that's reflected here on the stocks to use ratio. We just have ample supply of soybeans, and is reflected on that rising line for soybeans in the green color. Not so much for corn and wheat. This is really perplexing because globally, these numbers here would indicate we are tight for the grains, and therefore prices should be much higher. Yeah, indeed, corn and wheat prices are not as low as soybeans, but we would suspect that given the tightness in global supplies, we would have much higher prices. But this story is distorted by the value of the dollar, which we just saw earlier. Okay, so the fundamentals here of supply and demand are being influenced by global money flow. This is a trend that's happened over time. The United States is no longer the #1 exporter of corn, wheat, and soybeans. We have relinquished those roles over to other countries, specifically Russia for wheat, Brazil for soybeans. Right now, we are still a powerful importer or exporter of corn, but over time, we may lose that again to Brazil. So the currencies are taking a bigger role now than they ever have as these other world exporters gain more influence in market share. Export commitments are up across the board. As you can see here, total export commitments as measured by export sales as of January 1st are up for corn, soybeans, and wheat. But most of this is owed to the fact that we had bigger supplies to exports. And so even though we've had stronger export sales, we've had lower prices simply because we need still a faster export pace still in order to stimulate higher prices. We've seen that with corn. As you can see, the difference between this year versus last year on corn is a much bigger differential than what we've seen for soybeans and wheat. So the positive story on exports really here is about corn, and that has been a strong driver of why we've seen a price recovery in corn. Soybeans and wheat are still kind of waiting around for that export business to show up in force like we've seen for corn. And what's going on there with the demand story? Well, we got to look at who the customers are for our exports. You can see the top left pie chart there is our corn exports and who they go to. Clearly, Mexico is the important story there. Without Mexico, we really would not have been competitive on our corn exports. And that's important because Mexico is such an easy trade for the United States. We just dump the corn on a train and send it across the border. Whereas with soybeans, with China, for instance, China is buying about 45% of our soybeans. Years ago, China was much higher than that, and they've shifted away from the United States because they can bring in soybeans on boat from Brazil and Argentina just as easily as they can from the United States, and we've lost market share there. Also with wheat, Mexico has been an important destination there for wheat. You can see on the bottom pie chart there, but we've lost a lot of market share to Mexico over the years to Russia because they can ship Russian wheat across the ocean just as easily as they can bring it in from the United States. And so corn really here stands out as the export story, whereas soybeans and wheat have suffered quite a bit because we've lost export market share to our competitors, namely Russia and Brazil. We got to watch what's going on in Mexico, really, with the turn of the calendar here and with the turn of administration. And we're not talking just about what's happening here in the United States. Obviously, Donald Trump's going to be taking office on January 20th. But there was another election that had just as much of an influence on our exports to Mexico as the election here in the United States. And that was the Mexican presidential election. And with President Claudia Sheinbaum now president in Mexico, you can clearly see the impact on their currency. Again, why does this matter? Well, when the Mexican currency is weaker versus the dollar, they can't buy as much. Their peso just simply does not go as far when they are importing products of any kind from the United States. This is going to be interesting as things play out, because as we anticipate a trade war to start when Donald Trump takes office, we're anticipating the Mexican economy to weaken, because 80% of Mexico's exports go to the United States. And if they're in a trade war with such an important country like the United States, it stands to reason that their economy is going to weaken, and that is therefore going to weaken the Mexican peso even more, thereby diminishing their purchasing power and the number of bushels, therefore, that they are able to import from the United States. So, irony of ironies, when we pick a trade war with our trading partners, it typically does not go well for them, and they aren't as able to import from the United States. But back to the election of Mexican President Claudia Sheinbaum, why did that election have such a powerful influence on their currency? Well, the Sheinbaum administration is regarded as a very leftist government, and therefore the government or the market is not believing that their financial house is going to be in order. And so as a result, their currency has been weakening ever since she was elected. Some economists are anticipating that the Mexican currency, the peso, will weaken as much as 25 pesos to the dollar. That is very, very weak, and there's not a lot of bushels that they're going to be able to buy from the United States if their economy continues to weaken. We also have to watch what's going on in Brazil. This has been widely talked about. The weakening of the Brazilian real over the past couple of years has made their exports very competitive versus the United States. Now, why is the Brazilian real getting so weak? Well, it has to do with the election of President Lula and his policies of fiscal mismanagement. Basically, what's going on in these countries is they have runaway deficits. That's something that irony of ironies here. There are countries that have worse deficits here than the United States. I know that's hard to believe, but it is true. These countries have federal deficits that have really gone off the rails, and as such, their currencies have gotten a lot weaker. And the concern here going forward is that President Lula in Brazil is in denial about the weakening of his currency. He believes it's not his fault. He believes it's the central bank's fault, and that the entitlement spending is not going to change. Right now, Brazil's deficit is about 10% of their GDP. Compare that here to the United States. Ours is pretty bad at 6% of GDP. Brazil is at 10%. It's really a sad state of affairs there, and the market does not believe their fiscal house is going to be changed, and they're not going to be experiencing any fiscal discipline. And as a result, their currency is going to continue to weaken, and that's going to put Brazil's exports of soybeans and corn and cotton and rice and anything else that they export on sale. And that is going to be competing directly with U.S. exports and putting a lower floor on global prices of commodities. The last few minutes here, we're going to talk about the supply-demand fundamentals before I hand it over to Jacqui Fatka. We're going to talk about, first of all, what the crop situation is as it is with Brazil. Right now, the weather situation in Brazil is quite phenomenal, very favorable growing conditions for corn and soybeans. Right now, USDA is forecasting a record soybean crop and a record corn crop. Forecasts in the private sector are continually rise. Right now, USDA's got the Brazilian crop at about 169 million metric tons of soybeans. That's a record. There are private forecasters out there that are as high as 180 million tons on the Brazilian crop. Ladies and gentlemen, with the combination of a crop that's so huge with a currency that continues to fall out of bed, it's going to be a rough story for soybeans going forward. Then you add on top of that a trade war, and it's really hard to come up with any bullish scenario for soybeans going forward. At the same time, Brazil is expected to harvest a record corn crop. And so as a result they're going to be more competitive. That's going to be a story further out when they harvest the Safrinha corn crop following the soybean harvest. So that's later this summer. We'd see a lot of pressure from corn. In the near term, it's really going to be about how much pressure the Brazilian crop is going to bear down on soybean prices in March, April, May. As you can see here, conditions are very favorable in the main growing regions of Brazil. You can see the chart on the left, the moisture index from USDA, FAS, and their iPad charts. That blue sector there, they are excessive in moisture. Everywhere else around those main growing regions, they are in soil moisture abundance. So no concerns as it is right now, really, in the main growing regions. A touch of dryness down in the south, but really, on the whole, it's going to be a big crop, it looks like, from Brazil. In Argentina, a recovery in corn production. Soybean acreage down just a touch, but that's going to be made up for, more than made up for, for Brazil. Soybean exports, are going to be down a little bit for Argentina. A little bit of dryness here. Some of the private forecasters are lowering their projections on crop production in Argentina because it is a touch dry in those main growing regions of Cordoba and Santa Fe in the central growing regions and in Buenos Aires. So we have to see a change of fortunes there when it comes to weather and soil moisture in Argentina. For them to see an improvement in their crop forecast. But again, we just saw what it looks like in Brazil, and Brazil's got phenomenal weather. So whatever losses we see in Argentina will more than likely be made up for by the increases we see in Brazil. Turning our attention back here to demand in the United States, although we are seeing some headwinds to our exports for corn, wheat, and soybeans, we have a very phenomenal story here. And when it comes to domestic demand, feed demand has been a positive story here. As you can see here, the growth story for feed demand in cattle, at any rate, is in the dairy sector. It's been a tough time in the beef cattle sector, mostly because the herd is still in recovery phase. We have not cycled into full recovery yet with cattle prices so high, and so a lot of the heifers have been placed into, or heifers are going to feed yards, and that's constraining herd growth. And so as a result, the beef sector has not cycled into full growth mode yet, but we do have growth in the dairy cow sector, growth in the chicken and hog sectors as well. Positive stories there. So the demand side has been a positive. And that's reflected in the record crush here. For soybeans, not only is it a growing demand on the feed side, but really the biofuel sector side has been the huge success story driving growth in soybean crush in the United States. Again, Jackie's going to touch on this later on. The same for biofuel ethanol usage for corn continues to grow. However, we are seeing some weakening in demand there because the feed demand is so strong in the United States and the corn demand, export demand, has been solid. That export bid has been competing with ethanol demand, and as a result, the growth that we're seeing in ethanol usage for corn is starting to weaken. Although it is strong, we're seeing signs that usage is not as durable as what we've seen in the past. As you can see, that red line at the top, we record usage for ethanol. We see that weakening going forward as corn sees further exports in January, February, March. And last couple slides here, looking forward about what this means for crop acreage this spring. I know there's a lot that can happen in between now and spring, but you, the farmer, if you are farming, you're already making decisions on what your crop acreage is going to look like. And right now, the market is signaling there is a clear preference for corn versus soybeans and wheat for all the factors that we just talked about. Corn's had a phenomenal run on demand, whereas wheat and soybeans have had more headwinds. And so we fully anticipate there will be a shift of acres this spring over to corn. USDA's early forecast on acreage that was released in November and their baseline long-term agricultural forecast or their baseline projections called for corn acres rising to about 92 million acres, soybeans down a little bit, and wheat down a little bit as well. If this trend continues with corn being so competitive on price versus wheat and soybeans, we wouldn't be surprised to see a corn acreage number north of 94 million versus USDA's 92 million. It'll be interesting to see what USDA says at their Ag Outlook conference coming up here in the next month. I fully anticipate USDA is going to be a little bit more bullish on their corn acreage number and a little bit with fewer acres for soybeans and wheat. With that, I hand it over to my colleague, Jacqui Fatka, who's going to offer her outlook for biofuels and farm supply. Jacqui, the floor is yours.
Thank you. Well, he segued pretty well because so much is dependent on supply and demand. But as he ended that with some of the projections from USDA, and one of the big talking points that we often open up our discussions with is where the net farm income is. We've got to be able to make money, and as you look back at what USDA projected in February 2024 for last year, a lot bleaker situation than probably how we ended 2024 and likely going into 2025. A big part of that story is the higher livestock values, which really kind of offset those lower crop prices that we saw. And so, as you look over the history of the last 20 years, we all know that ag is very cyclical. We are coming off some really high times of 2022. But that drop the last couple of years has not been as dramatic as what they previously thought. So as we go forward and kind of deal with the reality of the fact that we do have lower prices, will the input costs come down alongside of that? And I think that's an important part of this discussion too. As you look at what happened from 2024 and then what they're projecting for 2025, not a lot of huge changes there. And this is just the corn, soybean, and wheat production expenses, but just minimal changes. And some of those we did see some decreases, a little bit lower fertilizer expenses, down 7%. Fuel and oil expenses were down 2% after a nearly 10% decline the year before. But then you have some things like seed, and we're not going to see a huge change in that. And I think definitely too for our grain producers, they realize that they can't sacrifice much on seed. And even when it comes to the chemicals, same situation. We're seeing a little bit lower interest expenses because we've seen a little bit of moderation, but that's still a major component of a lot of what they're dealing with, especially as we're looking at lower working capital. A lot of times in lower cycles, a key input cost is land values. And we've seen land values really climb substantially here over the last decade. We're starting to see a little softening in that. These are values from 2024. Iowa was up 4.1%. But, you look at what happened last year, we're seeing some weakening in that. I'm actually based remotely here in Ohio, so some of that big boost that we've seen, I mean, almost 10% increase in land values last year. Again, where we find that balance of softening the maybe demand, that higher value land is going to continue to hold its value, but that marginal land or lower producing land, you just can't pencil that out. But I always like to use, a real world example. And I grew up on a farm in Iowa. My dad still farms with my brother in Southwest Iowa. He recently just bought a farm a couple weeks ago, over a month ago, that he'd been renting for years, and actually will be paying more on that land now than he would have been renting it. But again, a lot about land is the location. You don't know when that neighboring farm's going to come up, and so sometimes you've got to lock that in. And I think that is still a really big part of this. But those interest rates are going to really drive some of this too. We don't really anticipate interest rates coming down a huge amount. We're not going to see the low levels that we had before. And the amount of working capital that's out in the countryside will also limit what farmers have to bring to the table to maybe purchase that land. And kind of building on that working capital situation, I think a lot of times people feel like in this cycle, we just don't have as much working capital out right there right now. But if you look back at where we were just 10 years ago, this year we do have quite a bit more working capital than we did even at the low of 2016 and that's 17 to 18 time period. And when you look at the debt to asset ratio and that debt to equity ratio, we're still in a pretty comfortable situation. Now, everybody has their own unique situation, and we're closely watching the farm bankruptcy numbers as well, which are slightly starting to tick up. And that's going to be important as we work through some of these lower prices, but still pretty elevated production cost. But for farmers, they got a pretty big Christmas gift right at the end of the year. The Congress passed right before Christmas $10 billion in aid, mostly to help deal with these higher production costs while the prices have not gone alongside with that. And this is in addition to, almost $21 billion in disaster aid. And so this is going to be pretty significant for farmers. And the other kind of amazing part of this is going to be aid coming quickly. This will actually written into law. It will be, payments should be made before March 21st. So pretty quick heading into this growing season, they're going to have this quick influx of cash to help pay for some of the seed or pay for, chemicals or fertilizer. And, this is going to help with managing some of those higher input costs. Most of those payments, 80% are going to go to corn, soy, and wheat producers. As you see here, the payments could be around $43 per acre for corn, almost 30 for soybeans, and a little over almost 31 for wheat. It's going to be also at the discretion of the Secretary of Ag to determine some of the variables about how this all figures out with their price, the cost, and the yields, potential yield loss. And there's also some payments on this. But, big story here, extra aid coming. We did get the Farm Bill extended, but also had this $10 billion in aid to help with these higher input costs as farmers are trying to manage this new environment that they're in right now. So kind of switching gears a little bit, feeding off of what Tanner had mentioned to you about just our ethanol and renewable diesel outlook. A lot of strong demand remains for fuel ethanol, not only domestically, but also around the world. And renewable diesel, mostly driven by the California market and their low carbon fuel standard, is really the big picture driver for both renewable diesel and even some biodiesel use as well. Pretty steady as we head into 2025, not a huge amount. Those other biofuel category is actually some of the byproducts from renewable diesel, and so just more of those being able to be integrated into the fuel supply as well. Big story for ethanol is really their exports, and our top destination continues to be Canada. Canada is a great trading partner, and for ethanol, a very important one as they've expanded their own biofuel mandates to encourage more domestic use of, encourage more blending domestically, and have imported a lot of our ethanol. But again, as we look at a potential trade war, there's a lot of unknowns. If we start taxing everything that comes in from Canada, do they instantly retaliate and take aim at our ethanol exports? Obviously, that would be pretty detrimental if something like that happened, but very much on our radar as we look forward. A strong year expected again on ethanol exports. One of the last slides that Tanner showed was just, our overall crushing right now. Always at this time of the year, we have a little bit lower demand just because we don't have as many cars driving. We do have more electric vehicles that are on the road. And so, just overall demand is always a little lower this time of year. We're starting to see some encouragement on higher ethanol blends, but nothing that's going to move the needle that much to push demand. But this ethanol exports is really helping consume our great efficient ethanol industry here in the US with very high production levels. So a year ago, we had published a report, Tanner and I and another one of our colleagues, about the renewable diesel industry and the demand created from it. And it's interesting what's happened within just a year, and as we looked back, we asked this question, are we going to be facing a renewable diesel boom or bust? And this is, a year ago, this is what we thought we were going to have. We thought we were going to have continued increased demand, really building on that. As we look forward now, we're seeing just a pretty, very minimal step up in demand for renewable diesel from 2024 to 2025. So instead of going from 5.51 to 5.96 billion gallons, we're now going from 5.12 to 5.2, and then steady for, even looking out through to 2026. We've made a lot of investment in a lot of soy crush facilities to help meet this demand. What we've seen, however, is we're seeing higher inclusions of soy oil, but also more competition from other feedstocks, including tallow and used cooking oil, that are sometimes being shipped in to the U.S. So as we go forward, the demand for that is something we're going to be watching. Maybe not that huge push that we had originally anticipated, but a more steady building out of that demand for renewable diesel. Part of the renewable diesel demand is also the sustainable aviation fuel. Several of the plants today that are pushing SAF also have the ability to produce renewable diesel, those same feedstocks for the HEFA process. So soy oil, used cooking oil, tallow can be used at these facilities to run either renewable diesel or SAF. So a lot of the tax credits and encouragement to get a greater tax incentive could push that needle to produce more SAF versus renewable diesel. So this is from EIA, but they're still projecting a renewable diesel growth and SAF growth there as well. But if we see some more states, right now Illinois has a state incentive to encourage more SAF. As we see some more of these pilot SAF plants transition over to larger scale plants or full scale commercial plants, we're going to maybe start to see that really shift towards more SAF, and so greater demand for those feedstocks to be used in SAF. So a little bit more on SAF, as we are coming out of the Biden administration, in 2021, they announced this grand challenge to produce 3 billion gallons of SAF by 2030. We did adequately add to what we had in 2021, 10 times more, but it's still a drop in the bucket when you're considering our total domestic fuel that we use for the aviation industry. So in the first half of 2024, we had 52 million gallons, but a lot of that was actually being imported from Singapore for SAF, only 16 million gallons produced domestically. But as you look at, can we meet that 2030 goal? And this is just a goal, this isn't a mandate. There is enough planned facilities or the ability to toggle back and forth between RD and SF for enough to meet that goal. Now, the question is, at one point, farmers were estimated to capture 93% of that market. That's really unlikely to be realized by the fact that we've got a lot of this used cooking oil and tallow. And the other major driver on this is the current carbon intensity scores. And so these different tax legislation, tax credits really incentivize those feedstocks that have a lower carbon intensity. And unfortunately, right now, the soy industry is not really getting credit, or the corn ethanol industry able to achieve credit for what they're doing on the climate smart practices. So that's one big thing that we're watching too. We turned the calendar to January. We were supposed to have this new tax credit called 45Z, but the carbon intensity score has to be below 50 to capture that. The 40B was another Inflation Reduction Act tax credit, which was just for SAF. And what we saw in that sneak peek really doesn't give the ability for farmers or rural America to actually really participate much in that market because of how 40B, it was a check the box approach. You had to do several, 3 different practices. You had to do reduced till, cover crops, and a nitrogen efficient product to be able to qualify, and only 15% of the acres would have qualified for that. Right now we're 2 weeks out from President-elect Trump coming into the office. There's still some hope that Secretary of Agriculture Tom Vilsack, before he leaves, would be able to release maybe their climate smart ag credits that you could use to help maybe encourage more adoption of those practices and capture that higher value. That rule from USDA is at the OMB. And so again, if I was going to Vegas, I wouldn't put money on it, but it is not out of the realm of possibility of what we could see here in the next couple of weeks. So big opportunity for corn farmers potentially if an ethanol plant was able to lower their score below 50, capture greater tax credit. They could maybe get as much as $1.57 per bushel that they would share between the ethanol producer and the corn farmer. And so being able to add that much value to the corn price is a game changer for rural America. And it's a huge opportunity for ethanol plants to improve their margins as well. When you look at what we're seeing with biodiesel plants, renewable diesel plants, they've been operating with the blender's tax credit for the last 20 years, which is $1 credit. Right now, as you look at these different feedstocks that are used in those different in the biodiesel, renewable diesel industry, with the carbon intensity score that we are using today, there'd be no value for soybean oil or canola oil. Distillers corn oil, which is a byproduct of the ethanol industry, they could get a tax credit with that because of their score. But again, your used cooking oil and your tallow, much greater opportunity unless you figure out how to really adequately reward the climate smart ag practices, that you could take that CI score for soy oil or canola oil and get it underneath that 50. So kind of switching a little bit of that, whether Vilsack will have that out in the Biden administration, there's a lot of talk from House Republicans, especially on how we could tweak 45Z. I think Vilsack would try to make something palatable if he does have it out so that it doesn't get instantly put on hold or not actually implemented. I think it's an opportunity for him to leave a legacy. And so we're going to be watching, does this get put into some kind of tax bill? There's been a lot of criticism from the Trump administration overall just on the Inflation Reduction Act and climate provisions in the first place. But at the end of the day, a lot of red America benefits from some of these tax credits. And so how we balance that going forward is going to be really important to watch. And, just taking another step back, as you look at all of the different ways that the Trump administration is going to implement their agenda. I think it's no secret that this is going to be different than their first time in office. You have so many different faces here sitting around the table with him, interestingly eating McDonald's. But you look there, House Speaker Johnson did get re-elected for the House Speaker. They have a very small margin. There's going to be a lot for them to push through, with a farm bill extension likely here in the next 2 years, because we still have not dealt with that. RFK Jr. over the FDA department, as well as, what are his thoughts on pesticides and the ability to use agricultural practices that do benefit the environment, but are challenged under some of his views. Also too, I want to note that Brooke Rollins, who is the USDA Ag Secretary nominee, a lot of positive things about her, but she's not very well known on some ag circles. I think most notably, though, she definitely has the ear of the president. And so, when she's in a room with a lot of folks and they're trying to figure out the impact to ag, I think he's going to listen to her, and her voice will be well executed and definitely heard and acted upon, which is good for agriculture. We're hearing that her hearing is going to come as soon as next week, so she may be already approved and ready to hit the ground running on January 20th when he comes into office. So just kind of summarizing a few of the things that both Tanner and I were able to hopefully communicate with you. Nimble marketers are going to be the best positioned to profit in the year ahead. I know there's a lot of doom and gloom from what we've shared, but there's also opportunities to continue to be profitable and for the U.S. ag industry to continue to be able to thrive in the days ahead. Tanner really executed it very well. The discussion on the impact of the foreign exchange rates and the South America influence continues to grow, and that's something that's not going to go away, and may also really become even more prevalent and important to watch here as we head into the Trump administration. And I think just at the end of the day, too, there's a lot of policies uncertainties, and they are going to cloud the biofuels and the ag trade outlook, and makes for a lot of interesting days ahead. And so with that, we're going to open it up with questions. And I will, I think both Tanner and I can take questions now.
Yes, so it looks like we have a couple. To start, if Trump puts tariffs on Canada, Mexico, and China, how low will wheat, corn, and soybeans go?
Yeah, great question. There's a lot of unknowns there. The market is probably pricing that in already. And I would assume, there's going to be some sort of retaliatory effort from our trading partners, but we don't know what that looks like. We'd have to see how bad they retaliate, and then what the market's response is going to be, and how radical or how much speculative flow we'll see in the commodities. But it's suffice to say there's going to be some sort of negative impact probably on commodities for corn, wheat, and soybean prices. But we really have to see how our trading partners respond and how long the tariffs would be in place. Some of the commentary I've heard out there is that Donald Trump's tariffs would only be momentary. They're tactical to get what he wants, and then he'd pull them off. I'm not so certain about that, because a lot of the tariffs that he imposed last time he was in office are still in place. And so given that, I would say, we're really going to have to see what the retaliation is going to be. I think we're already seeing the impacts of the expectation of a trade war right now. China is already buying a lot of, or making a lot of purchases out of South America for soybeans. I'm curious about what's going to happen with corn in Mexico. It looks like they're already trying to acquiesce to the U.S. One of the things they've done that's a positive sign at any rate was here recently, the USMCA panel ruled in favor of the United States on genetically engineered white corn, and Mexico said they're going to comply with that. that they have to comply by February 3rd. So those are positive signals that Mexico is wanting to work with the United States. It's hard to say at this say right now how bad the market response would be. But I would say the market is probably already pricing in some sort of retaliation.
Great, thank you. And then somebody is asking about the oat market, if you have any outlook or insight on that for the year to come.
Oats, yeah, I haven't followed oats admittedly as much. I would say oats are going to really be impacted by what's going on with corn. All the feed grains are going to be really impacted by what happens with corn. And so right now with corn at any rate, having a recovery on price over the last several weeks, my idea here is that there would be some sort of influence on oats, but oats really gets into a whole other dynamic there with cover crops, with the food grade oats, and oats exposure to what happens to the food market. So I really want to withhold any analysis on that, other than the fact that I think it would be impacted a lot by what happens with corn.
We've got another one. What are your thoughts on the farm economic consequence of the Trudeau resignation, which just happened today?
Jackie, you want to take that one?
Sure. I mean, I think you look back and Trudeau was actually down at Trump's headquarters very shortly after Trump made that claim that he was going to put tariffs on both both Canada and Mexico. So, Trudeau has probably caught some criticism of that, but then you've seen reports too that Trump just said, well, why don't we just make Canada a state of the U.S.? Maybe this is, I think we're all waiting to see the impact of Trump in this next term. And again, are tariffs a threat? Are they a negotiating tactic? I think whoever is going to be stepping into that role with Canada, the fact that he stepped down today, that's going to create probably more of a challenge for Canada negotiating going forward, because they don't have someone today that's really probably able to do that with as much power and wielding that power as Justin Trudeau would have been able to today.
Got it. Thank you. I guess there's no more questions. So with that, I just want to thank Tanner and Jackie for their presentation. And then another reminder that both the presentation slides and the recorded webinar will be available on the Farm Credit East website under webinars. Again, thank you, Tanner and Jackie.
Yeah, and I'll just put one last plug in. I didn't close our presentation. Tanner and I and a couple of our colleagues, we put out a Monday newsletter that's free for anyone who wants to read it, just to kind of give an ongoing update on some of these different issues that we're watching and tracking. So if you're interested in receiving our Gleanings newsletter, please feel free to email myself or Tanner, or any other questions you might have had following up on our presentation. We're happy to help answer those if they come to our way.
Sounds great. Thank you.